Hello, welcome back, guys. I hope you are doing well. I am creating new content these days with some new equipment, so it's exciting, some new microphones and stuff. And soon I will be making some videos pretty much presenting myself as well. So stay tuned for that. And if you are new around here, become a subscriber if you are interested in this kind of content. And please leave a like as well, that helps a ton. Now, I wanted to make a video about ContextLogic here, that is wish.com, pretty much a very well known online store. And there is a reason for this, and there is a potentially an interesting lesson for new investors, for investors who are really new in the field of investing and can make this sort of mistake for which I'm going to talk about in this video. Now, ContextLogic, you will see that it is down 85% since its 1 year high, and you may be wondering how low can it go? And that's a fallacy, and a very, very well known fallacy when we're talking about investing. Because there are many cases where you look at this price and you are like, okay, how low can this go? I mean, it can only go up from here, right? But that is nowhere near the actual case for many, many reasons. First of all, if the business is not doing well, this can actually drop to zero at some point. It can actually even go bankrupt. And also, the fact that it is $1 and actually less than $1 right now requires the company to make a decision, because a stock that is less than $1 for a while eventually gets delisted and becomes OTC. And so they will more than likely will have to eventually do a reverse split. And a reverse split basically takes the amount of outstanding shares and creates multiple shares per the current amount of stock that exists. So, for example, if they do let's just say a reverse split of like one share becomes 10 shares, then you are going to be getting an outstanding shares that's actually division of 667 million by 10. And now you will have this price multiplied by 10. You will have an about $10 stock, and it can go down from there. And it has happened in various situations actually. So if the business is not doing well, this is bad news for an investor, and you should never, never, ever actually be buying a stock just because it's down a lot. There has to be a reason. Now, if a stock is down a lot and the underlying business is good, then it is a very, very good idea to be buying a stock, of course. And I really, really wanted to make a video and stress this point out, because I have done this mistake myself many years ago when I was pretty much beginning my investing career, pretty much. And I have bought some stocks that were doing pretty much horribly. And back then I didn't have much of an idea on how to really analyze businesses. And so I was like, okay, this is down a lot, maybe it deserves a buy, and then it goes down even lower. Because cheap gets cheaper in the stock market if it's not valuable enough, and that's something that you always need to remember. Now, of course, again, if we're having value, then buying for cheap is great. But let's examine, do we actually have value for this one? Is the question that we always need to be answering before buying into a single company, to any single company. Now, the P ratio of the company is in the negative, which is always a bad sign to see, because it actually points to a company that's not making money here. And the price to free cash flow is also in the negative over here. The outstanding shares of the company, take a look at this one. The company has been issuing a ton of shares, trying to take advantage of the increasing stock price for a while, at least while it was increasing. Now, as you can see, it's kind of going down. Actually, it's really going down pretty much every day. And there hasn't been a point where it seems to be climbing up again, at least so far. And the thing is, the company has issued like 6 times the amount of stock that they had some time ago. So starting from about 100 million, now they have almost 700 million outstanding shares. So massively diluting investors here. And yes, they do increase their revenue overall. But the thing is, what's the point of increasing your revenue if you're not making money? Because if I give you stuff for free pretty much, and I don't make any profit, then I can sell a lot. But the thing is, am I really making money? And this is super important for businesses. For any business, really, you need to be bringing the bread home. Otherwise, it doesn't make any sense for anybody to invest in you. And in terms of the net income growth, and the even worse, the free cash flow growth, the company has been doing really, really bad here. At some point, they seem to have been doing a little bit better, but right now, again, they're in the negative. And it's only their total equity that is growing, because they are basically printing shares like crazy, as you'll see here. They have brought out the printers and issuing shares like mad maniacs here, as you can see. And you will also see that their margins are negative, returns are negative, as expected, of course. And we can always take a little bit of a look here at financial statements, which will tell us the story of a company that is increasing their revenues, which of course is important. But the most important thing, are you actually making money? And they are not. And it's getting more and more into negative territory. A little bit better than last year, but still pretty comfortably in negative territory here. Not nice to see at all. And to take a look at this negative price action here, net income action. So in terms of the balance sheet here, the only thing that pretty much is saving the company is the additional paid-in capital. 3.3 billion, 3.2 billion over here is the only reason why the total equity is positive instead of negative. And the company is having quite some total liabilities, getting a little bit better in regards to this one, but overall still have significant total liabilities because, this 500 million may not sound a lot, but if you take a look at their cash flow statement, it's actually being in negative territory. This is a big problem, because how do you actually pay these total liabilities? There's only two possible ways. You either get some extra debt or you issue more shares, and both of these are dire situations for investors, something that we don't like to see at all. And you will see here that we are firmly in negative territory as well. Over here in our operating cash flow, investing activities, basically nothing happening, and the same thing with financing. But overall, free cash flow is firmly into negative territory over here. The company is just not profitable, and it's losing more and more money here. Terrible, just terrible to see. And of course, if we take a little bit of a look here at our stock evaluation tool, you will see that the revenue growth of the company is important, of course, and again, you will see that the company has been growing at a 16%. It's like a measly 16% overall in the last 5 years. And if you're investing in these sorts of companies, you really need to be seeing the growth. Otherwise, what are you investing in when the company is not really making any money? And so, if we go, let's just say 12, 14, and 16, which I'm not even sure if the company will be achieving at some point in the future, really. The problem is, take a look at these net income margins here. They are always negative, and things seem to be getting better, but the company was annihilated in the COVID area, and it looks like they're still firmly into negative territory over here. So what do you do? Like, how can you approach this? Using a discounted cash flow model, it's going to be difficult. So we need to assume marginal profitability, something like 1, 3, and 5% potentially of net income margins. And in terms of the free cash flow margins, again, firmly into negative territory over here, we have to go with something that is sort of like normalized way of having your free cash flow derived from net income, which would be about 80, 90, or 100% of your net income pretty much becoming free cash flow. An annual return of 13 or even more is what you should be asking for here. Frankly, I would probably ask for 15% on this one, just because it's super risky. But the problem is, I have already had some assumptions that are very aggressive here. Net income margin of 1, 3, and 5% is nowhere near what this company is doing. You can kind of see it here. This assumes a lot of good things happening for the company, and they are nowhere near actually happening in real life. This is just an exercise to see how much the company is worth if they actually manage to achieve some marginal profitability, is what we're doing here. Otherwise, there's not much to talk about here. This is a company that's pretty much failing right now. And if we hit calculate using these metrics, you will see that our low estimates are still in the red. And imagine that we are nowhere near that, right? Again, net income margin of 1% is nowhere near happening right now. The company is losing money. And even our medium ones, yeah, there are $2 over here, which is in the green. And currently we're sitting at $1. But, it would be much better if there was pretty much a much higher value, because it would indicate that the company was less expensive. So, even with these kinds of estimates, this is not as cheap as you would hope for. And so this is a company that I would have a lot of trouble potentially adding to a portfolio. I think it's a massive risk here to potentially be adding this one to any portfolio, or having bought that some time ago. And I could definitely see some investors who are new in the field pretty much taking a look at this company and be like, okay, this is down every month, and maybe they bought it over here, somebody bought here, somebody then bought here, maybe the average down over here, and then they kept buying because it kept going lower and lower. And how low can it go? And the thing is, it can go to 0, or it can go to $10 with a reverse split and then head downwards again. and then head down to $1 again from $10. It has happened many times with many companies that were actually even much more profitable than this one, frankly. It has happened to them as well once things went the wrong way. So be extra careful and do not just buy companies just because they are actually going down. You need to be examining the financials, and this is what I really want to help you with my videos. It's really important to be buying companies that make sense for an investor to be buying, and not just pretty much look into the hype or look into cheap prices and basically just buy because it's cheap. Because again, cheap has to be cheap when it's good as well. Otherwise, as an investor, we should, generally speaking, just stay away from it. But thank you for watching this one. Tell me what you think about ContextLogic, guys. Leave a comment below. I'd love to hear your opinions. And generally speaking, about these kinds of companies that are sort of like traps for new investors. Tell me your opinion about this kind of situation. And thank you for watching this one again. I'll see you in the very next video. Bye for now. I'll see you soon.